This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So you're probably finding now that your head hurts. You've gone through and looked at quite a lot of information to do with how we consolidate, how we calculate group retained earnings, non-controlling interest, and also in the last session we looked at goodwill, didn't we? Oh wow, that's a lot to calculate, isn't it? Hopefully what we'll now find out within this next bit, things will become a bit easier, okay, because we're going to look at some standardized workings. But before we do, what I'd just like you to do is just to go back and try and remember, take a separate page of paper, and on that separate page of paper, I'd like you to calculate three things. First of all, group retained earnings. So write out how we calculated group retained earnings. What was the formula, if you so wish, or the standard methodology? How do we calculate non-controlling interest? And then how do we calculate goodwill? Try and write out those three standard methods of calculating group retained earnings, non-controlling interest, and goodwill. Stop the video. Now, hopefully you've restarted it. You've done what I asked you and you have written them down and at least can remember what they are. Okay, because now the workings build upon that knowledge or use what you've just done and helps you out that little bit more. Working number one, you will see, is not very exciting. You just need to identify the parent, identify the subsidiary, identify the level of control, and on top of that, you could also work out the non-controlling interest percentage. You could also, as well, I suppose, identify whether it's the fair value method or the proportionate share of net assets method to go through there and value the NCI. Another thing that I would try and get used to looking at is the acquisition date. That becomes vitally important, particularly when we look at the consolidated statement of profit or loss. But let's note it anyway, even though we're looking at the SFP. In the exam, don't bother drawing up the group structure. Okay, you should be quite comfortable working that out. The only other thing that I suppose I could add, maybe a little bit of a side, it depends on what you get within the exam, doesn't it? But you might not be told the number of shares or might not be told the percentage that you own. To be able to calculate it, you can look at the number of S shares that you have bought. So maybe 75,000 divided by the number of S shares in issue. So if I bought 75,000, if there's 100 that are in issue, I own 75%. Okay. Most questions I've seen, particularly in the trial or the mock exam, tend to give you the percentage, but just in case. Then what we have next working is the net assets of the subsidiary. I think this is the real important one then that helps feed into goodwill, NCI, and group retained earnings, because we look at the net assets of the subsidiary at 2 points in time. We look there at the reporting date. We look there at what happens at the date of acquisition. Okay. Remember, when we look at the net assets, we don't look at each individual asset and liability. We look at the equity section, don't we? So we take, if you like, the equity section, which is equal to the net assets of the sub, and look at it at the reporting date and at the date of acquisition. Okay. Again, what you tend to find is that the reporting date figures could be given to you on the SFP at the year end. Whatever the equity shares are, they are the same as at acquisition. If you're given share premium, they are the same as at acquisition as well. Okay. The retained earnings at year end, so at the reporting date, again come from S's SFP. You may need to go through there and calculate or work out or even be given the retained earnings at the acquisition dates. Okay. Then what you do is you take the reporting date figure, subtract the acquisition date, and that will then go through there and give you your post-acquisition figure. Okay. Wow. Why is that useful? Why is that relevant? Well, first of all, the net assets at acquisition are very useful because that's going to help you calculate your goodwill, isn't it? Okay. And if we look at the post-acquisition movement in retained earnings, well, part of that we've seen previously in within group retained earnings and also within the non-controlling interest. So by drawing up that diagram there, or that standard working, you can work out quite a lot of useful bits of information. Okay, so what we've got there is the next working is your goodwill. So we've looked at the cost, we've added on the NCI and deducted the net assets. Technically, as we'll see in a later video, it's the fair value of the consideration. So for now, we're just focusing on the cash that we have paid. The non-controlling interest at acquisition. So again, that's either going to be based upon your percentage of net assets or the fair value method, isn't it? So you need to read the question carefully as to how that is done. And then you take the net asset to acquisition. Again, don't worry that it says fair value of net asset to acquisition. We look at that more when it gets to F2. But that figure there then appears within your calculation there. Okay, your net asset to acquisition being your share capital, share premium, retained earnings at the date of acquisition. Okay, non-controlling interest. Again, if you've stopped the video before and rewrote out the standard working, you'll hopefully have seen there that you take the NCI acquisition. So this figure that you have here should be exactly the same figure that you have within your goodwill calculation. Again, the NCI is either on the proportionate share of net assets or the fair value method. Okay. Again, you then, in the non-controlling interest, you add on the non-controlling interest share of S's post-acquisition profits. Again, you've worked out S's post-acquisition profits in your net assets working, if you like, working number 2. Okay, excellent. The last working that you've got is it there as working number 5, your group retained earnings. So again, remember, non-controlling interest is showing ownership, and so is group retained earnings. When we're looking at group retained earnings, it's 100% of the parent's retained earnings. And here what you then do is you add on P's share of S's post-acquisition profits. Okay, so again, that post-acquisition profit figure comes from working number 2. So it looks at the movement in net assets from the acquisition date to the reporting date, and that figure then feeds in, for which you take P share in the group retained earnings, and you take the NCI share in the non-controlling interest working. Okay, there we go. So there's 5 standard workings. Of those 5, you only need the 4, 2, 3, 4, and 5. Okay, I always like to still throw in working number 1, just to get you thinking about the NCI percentage, how the NCI is measured, and what the acquisition date is, because I think the more you pick that up early on, the better things then become. Okay, there you go. That's all of the workings. Again, once we've finished the video, have a quick chat or a quick talk or refresh through those workings. So are you happy with all of those standard workings? You think so? Yeah. If you want, feel free to just go through and work the example yourself before I chat through it, and then come back, restart the video and see how you get on. It's entirely up to you. Or alternatively, you can just sit and listen to me for the next 15-20 minutes as we work through the example. It's up to you. I do not mind. Okay, so what have we got? So the example there is called workings. So nice and simple, sort of giving the game away. It wants us to go through there and prepare the statement of financial position for the Matthews group. So Matthews must be the parent, and it wants us there to prepare it for the year ended December X5. Okay, so we know Matthews is the parent, so we can think there about the group structure then, can't we? Who is the subsidiary? Well, the subsidiary must be Jones, obviously, based upon the information given in the question, but it does say we own 80% of Jones, so Jones is the subsidiary. We paid, was it 600,000 2 years ago, and you can see that investment is reflected there, isn't it, within the SFP of Matthews. So when we consolidate, we will be ignoring that, won't we? Okay, that there's nothing left. It tells us there Jones's retained earnings at that date showed a balance of 100,000. So it's actually giving us the retained earnings at acquisition, which was 2 years ago. Okay, so we know the NCI is 20. We know it was acquired 2 years ago, so there is no mid-year acquisition as such, which we'll touch upon later. and we are given the retained earnings at acquisition, which is important because that will then give us the net assets at acquisition. Okay. Bits and pieces that you've got, if you look through the financial statements, we're going to consolidate P&S line by line, assets and liabilities, aren't we? Okay, so that was always the first step. We're going to put in the share capital of the parent only, aren't we? Okay, they're at 500. And then we need to calculate things such as goodwill, NCI group retained earnings. Again, remember in working number 1, it also wants us to go through and think about how we measure the NCI, not just what the percentage is. So that 20% NCI here is based on the fair value method. Okay, and that fair value, we are told, was 200,000 at acquisition. No need for us to go through there and calculate it in this respect. Okay, so as we're focusing on the workings, I think it's probably a good idea to actually start with the workings. Okay, and again, what I'm going to go through and do is I'm going to cheat. I'm going to start off with working 2, which is the net asset of the subsidiary. Okay, we look at that, remember, at 2 points in time. So at year end, we look at it at acquisition, and then based upon those 2 points in time, we can work out the post-acquisition movement, can't we? So what have we got? The year-end net assets. Remember, we talk about net assets, but we are referring to equity, aren't we? So we have share capital and retained earnings of 200 and 400. So share capital, retained earnings, 200 and 400. That 200 is then copied across, isn't it? It will never, ever, ever change in your exam. It will do in real life, but let's not worry about that though. The retained earnings at the date of acquisition, I think, were 100. Were they? Yes, they were. You can see them there, right at the very top, can't you? Okay, all done, all good so far. And there's no funky adjustments just as yet. So we have, is it 600 at year end, 300 at acquisition. The post-acquisition movement is 300, isn't it? Okay, excellent. Everybody happy with that? Brilliant. What we can then go through and do is we can then work out goodwill, can't we? Which is your third working. So remember, that goes through there and looks at the cost. So technically the fair value consideration, but the cost in terms of what we paid. We add on the NCI, which we know is at fair value, and then we deduct our net asset at acquisition from working 2. Okay. So the cost, how much did we pay? I think that was 600, wasn't it? We paid, was it 600? The non-controlling interest based on fair value is 200, and the net assets at acquisition, I think, were 300. Excellent. Okay. So again, if you're wondering where they are from, the cost is the 600,000 there, isn't it? The non-controlling interest at acquisition was 200, and then the net assets from working 2 are those 300 there, aren't they? Okay, there we go. Again, what that has done there is that has given you your goodwill at acquisition. Remember, we don't need to do the split, but just so you're happy with terminology, as we have used the fair value method to calculate the NCI, we therefore go through and refer to the goodwill as the full goodwill, because that is made up of the parent and the non-controlling interest share of goodwill. You could split it if you want, but I'm not worried about that. Okay, excellent. Working number 4 is my non-controlling interest. So we take the non-controlling interest at the date of acquisition. So was that my 200, to which I add on the non-controlling interest share, 20% of the post-acquisition profits of the subsidiary. The post-acquisition profits are again from working 2. Again, if you're unsure where that comes from, voila. Okay, you can see it there, in that we have that 300 post-acquisition profits. Okay, purely coincidental that the post-acquisition movement is the same as the net asset to acquisition. Totaling that up, does that go through there and give me, is it 260? And then the last working that we have is that the working number 5 is the group retained earnings. So again, standard calculation. The parent shareholders own all of their retained earnings, don't they? So there, that is that 500. Oh, careful. No, that's the share capital. Careful, Christopher. 800, isn't it? Okay. So the parent share capital is there as, sorry, parent retained earnings, Christopher, get a grip of yourself, is there as 800, to which we then add on our share 80% of the post-acquisition profits, which we know come from working 2. 80% of 300 is 240. Add that together gives me 1040. Okay, that is the group retained earnings at the end of the year. Okay, excellent. We then need to prepare the full consolidation. None of this objective test business. We're going to prepare everything so that you can then adapt with a full, thorough understanding of how it works and answer any of the questions. I do think it really does help. So what you've got there is is it your non-current assets? We're going to consolidate 100%, 1,000 plus 500. If I see anybody taking 80% of the subsidiary, you will be in trouble. Okay, I'll travel down the internet right the way to your home or wherever you are sitting there, and I will give you a severe telling off. Okay, we have control. If we have control, we consolidate all of the assets and all of the liabilities, don't we? So 100%. Understood? Good. Okay, excellent. We also have, is it your goodwill? Goodwill, I can reference to working 3. My calculation of goodwill revealed, I think, a goodwill figure of 500. So I put my goodwill of 500. My current assets are there as 800 plus 600, which gives me 400. And I think if you total that up, it gives you 400. Okay, it's there when you sit and hope that when you work out the equity and liability section, it then balances. Here's hoping. So what you've got there is you have your equity share capital of the parent. So remember, we're reporting to the parent, so it's 100% of P only. That's 500. We then have, is it your group retained earnings from working 5? Okay, you'll probably be quicker than me at finding it, but it's there as 1040. You could if you want, you don't have to, but just so you have a thorough understanding, that 1540 is the equity attributable to the parent. That's essentially what the parent owns. It owns all of its share capital, all of its retained earnings, and its share of S's post-acquisition. The non-controlling interest is there as working 4. Working number 4, the NCI was there as 260. You can see it hidden away somewhere up there. So if I add 260, 1,71800. So that gives you, is it the equity And the liabilities you can add across, was it 100 plus 500 gives me 600, even if it weren't a balance. I would still write 400 because I know that is what the figure should be, isn't it? So I have the assets at the top of 400. The equity and the liabilities at the bottom are there as 400. Okay, so it balances. Excellent. There we go. Again, you're not going to be asked to prepare the full group SFP within the exam. What you're going to have to do is prepare the extracts, aren't we? So you might have to calculate group retained earnings. You might have to calculate non-controlling interest. You might have to calculate your goodwill. And the key bit is that you use the workings. So if it says calculate goodwill, you've got your standard working there. Okay. Key bit, you need to work out the net asset to acquisition. So if it just asks you to calculate goodwill, maybe you don't need to do a full working too. You would just need to go through there, wouldn't you, and do part of it to work out the net asset to acquisition. Okay, you wouldn't need to do the full, if you like, year-end figures and post-acquisition movement as well. If it was there, say it asks you to work out your non-controlling interest, again, you know what the NCI acquisition is. You need to work out, don't you, that the post-acquisition movements in retained earnings. So again, you could go back to working two and do the full working two, maybe just focusing, if you like, on the movement on retained earnings. Okay, because as we said, the share capital is always going to be the same, isn't it? It's never going to move. So the movement in the retained earnings of 300 is always going to be the same as the movement, if you like, within the net assets. Okay, so just maybe adapt these traditional standard workings to fit with the objective test style questions. The more you can do that, the more you see of it, the better you'll become, and the easier this will be. Admittedly, I think you're probably finding it quite difficult at the moment because we've covered an awful lot of information in a pretty short space of time, but stick with it. Okay, have a go at some of the questions and then see how you are getting on. If you're stuck, you know where we are.